Awesome, I see more people coming in as we speak. For those coming in, we're just allowing folks to pop into the webinar. All Zoom delays accommodated, and then we'll get started. All right, I think we can get going. So hello and welcome everyone to the Jain Family Institute's urgent forum on the student debt crisis and ongoing policy debate surrounding the need for higher ed debt relief, at least through the course of the pandemic and economic downturn. My name is Hala Ahmed, and I serve as the PR and Policy Communications lead at JFI. For those who are less familiar, JFI is a nonprofit, nonpartisan applied research organization based in New York City with a particular focus on higher education finance among our core research areas. In this session, alongside our in-house experts, Laura Beamer and Marshall Steinbaum, we're joined by our partners in higher education debt research and policy, namely the Center for American Progress, the Roosevelt Institute, Student Borrower Protection Center, National Consumer Law Center, the Education Trust, Roosevelt Institute, and the Century Foundation. Of course, that means we have a packed hour and incredible expertise. So by way of context, the motivation for this forum is the ongoing policy debate and negotiations surrounding continued debt relief throughout the pandemic. The event is structured in two parts, starting with a focus on vital research perspectives on the student debt crisis within the pandemic, followed by an opportunity for a question and answer. Then in the second part, we'll dig into the legislative proposals that seek to respond to that acute debt crisis faced by over 40 million students, and I should say 1 in 5 Americans dealing with student debt. And that policy portion will also be followed by an opportunity for question and answer for the panelists. Of course, I'd like to thank our panelists for joining this important conversation. Many of the groups are part of the Higher Ed Not Debt Coalition, and I'd like to also give a brief plug for another event on student debt coming up on August 13th, featuring Senator Warren's Senior Education Policy Advisor, Josh Delaney, who unfortunately could not make it today. And that event is hosted by CLASP. Event registration information is going to appear in the chat shortly. Finally, brief housekeeping. So Q&A, please reserve for after the presentations and use the Q&A function or the chat. We'll be monitoring that and moderating just lightly so that we can touch on key points and move things along. For the media and staffers that have joined this session, I'm happy to connect you with our presenters for follow-up afterwards as needed. I'll be linking to relevant reports in the chat as well as folks speak, so be also aware that we're live tweeting many of the resources folks will be discussing today from our Jain Family Institute Twitter account, and I encourage folks to share if they'd like to amplify some of the perspectives that they're hearing, particularly as Congress maintains potentially harmful stalemate on this legislation. And note that we are recording and live streaming this session. Please be informed that if you would like to be excluded from the recording, we have the opportunity to unmute folks to voice their questions in the Q&A, but if you'd like to not be part of the recording, please just put it in the chat and we'll read it out, and note that you'd like to be anonymous. With that, I'd like to start with Laura Beamer, lead researcher in higher education finance at JFI, who has authored an important series on millennial student debt. Laura, if you can start us off with what the research shows on student debt and your most recent findings.
Yeah, for sure. Thanks, Hala. Hey, everyone. My name is Laura Beamer. As Hala said, I'm lead researcher in higher ed finance at Jain Family Institute. And I'm excited to tell you guys about our millennial student debt research. Millennial student debt is a research project investigating financial, workforce, and geospatial behavior of millennials with student debt. but in analyzing student debt in the US and of course the many repercussions of its ballooning status, we also want to examine the inequities in access, which exacerbate student debt, especially for various groups and communities. But what about access am I talking about? Of course, we all know there's various kinds. Access can mean access to financial products to pay for school, physical access to an actual campus. It can mean access to learning resources, access to a specific major or degree that a person seeks, access to information before enrollment. The list goes on. But our upcoming publication, a little plug here at the end of the month, is going to speak entirely to financial access. We've acquired individual level credit bureau data that breaks down student debt statistics by zip code. But the first two posts in Millennial student debt, the latest of which came out at the end of June, are focused on geographical access. So we looked at every zip code in the US and US territories since 2008. And we want to look at the interaction of geographic access, what it has with different higher ed costs and sticker price and other zip level demographic attributes. So there kind of went a lot into, there's a lot that goes into measuring geographic access, as you can imagine. We used iPads and ACS data and a lot of elbow grease. We pinpointed all the higher ed institutions and the hundreds of branch campuses across the country, starting in 2008 until 2017. And we established commuting distances around those campuses using various driving distances. So now for every zip, we have a list of institutions for that zip that are considered geographically accessible. And because we used iPads, we have a lot of information on those institutions that together describe different forms of access. So I'm talking about the types of institutions, the programs they offer, enrollment numbers, sticker price, net cost. So now we have a zip that has a unique, every zip that has a unique list of local institutions and their characteristics, and we wanted to make some calculations to streamline analysis. So the first calculation was a concentration index to measure institutional enrollment concentration for each zip code. And we called that the school concentration index. And then our second calculation was an average net price for each zip code. What is that zip? What are the people in that zip facing on average for the net price for the institutions around them? Some of our main findings are that access has become more geographically unequal since 2008. Poor zip codes have much less access than their wealthier counterparts. And of course, we know that costs are going up for everyone, but people in highly concentrated zips are also seeing real-time effects in the quantity, quality, and types of programs that they're consigned to if they decide that they want to attend an in-person program or go to a physical campus. So of course, the student debt crisis is going to be affected by the fact that every year the trends are showing millions of people are losing geographic access to higher ed. And of course are being consigned to the various negative impacts of that and less opportunities. So to wrap up, in our next publication at the end of this month, we'll be able to talk more about how debt is specifically affected by these various types of access issues, like our school concentration index and average net price variables.
Thank you, Laura. And Marshall, turning to you, speaking of decreased access in higher education, what does the research mean for student debt and cost of attendance? And what are the key trends that you're most concerned about?
Yes, thanks a lot. So as Laura mentioned, we calculated the school concentration index, which basically says how concentrated at individual institutions is the enrollment within the institutions that are available in a certain driving radius of a given zip code. And so overall, the aggregate kind of average of that concentration index has been rising over time. And our interpretation of that is basically that a lot of the for-profit institutions have lost enrollment relative to the more traditional institutions over the period 2008 to 2017, but that's because the traditional institutions have effectively adopted for-profit-like business models. So they've expanded their enrollment, including through offering more degree programs. They've expanded online degree programs, and I think a big cause of the adoption of for-profit business models on the part of more traditional institutions is the declining state support for public higher education. So in the absence or the diminution of state support, institutions are in search of alternative sources of revenue overall and revenue per student. And so that means that they're expanding enrollment and offering non-traditional degree programs, that sort of thing. And I think also a major component that you can see in the comparison of net price versus sticker price from the IPEDS data is basically that the school financial, there's baked into that is a number of different things, including costs of attendance that go beyond tuition, be it sticker price tuition and then net of financial aid. But one of the things that's going on, I think, is that financial aid policies are becoming more inegalitarian. So when we think of financial aid as discounting sticker price tuition, that could be because students who are able to contribute more, whose families are able to contribute more, pay a higher net price, and the financial aid is going to defray the cost of attendance for worse off students. That's an egalitarian model of price discrimination. That is shifting in the absence of state support. That is shifting towards an inegalitarian model wherein it's the students who have more options to go elsewhere, that are choosing from a larger number of schools that are induced to go to a given school or given a package through financial aid that makes a given school more attractive to them. And the students who have access to a greater variety of institutions who are more mobile, you could say, tend to be the ones from a better off background. So that is a big mechanism by which I think the student debt crisis is exacerbated. In particular, its inegalitarian aspect to it. That is, worse off students from a relatively disadvantaged backgrounds more and more taking on more student debt because they, in effect, face higher net tuition, or at least the tuition that is charged to students from different backgrounds is becoming more inegalitarian. And then to sum that up, I guess I would point to the ongoing crisis, both with the conduct of the opening of universities in light of the pandemic, but then also the state budget austerity that's likely to exacerbate the declining funding picture that causes institutions to seek out these more for-profit-like business models. That's going to, I think, likely get worse, and therefore that's going to make the student debt crisis worse in the coming years. And I mean, I think another aspect of this, I want to kind of highlight some research I did with Julie a couple of years ago, pertains to the poor health of the labor market, creating a dynamic of what we call credentialization, where the cost of job training, of obtaining the credentials necessary to obtain a certain position gets higher for the workers. So the cost of job training is basically shifted from employers or institutions to individual workers / students. It's been over a decade of slow recovery from the Great Recession, wherein I think the credentialization dynamic was a big engine of the student debt crisis. And then now we're facing another labor market recession where it's likely that that dynamic will be further exacerbated.
Thank you, Marshall. That's a great segue over to Julie. And Julie, if you could speak a little bit more, I know a number of folks on this call have dealt specifically with the issue of racial inequality in higher education debt. And if you could speak to that issue and what are the key ways folks should understand the debt trends as they're made worse by the pandemic and the long-term and interim needs for a solution.
Sure. So let's see. As Marshall was talking, it was making me think in the paper that we wrote together a couple of years ago, started with and I think a lot of our work on this kind of starts with like what the key assumptions have been around our student loan program that allowed it to proliferate in the way that it did, and the extent to which those assumptions have held true. So And one I think that we don't maybe mention enough, but that Marshall just reminded me of is, one of the core assumptions at the start of the student loan program was that student loans were for middle income students, that grants from the government would cover costs for lower income students, and that student loans were just there for families that needed a little bit of help to meet tuition costs. So that was one of the major assumptions right from the start. Another was that more, student loans would get people more education, and that would give them more earnings in the labor market, right? That's another core assumption. And then I think that the third core assumption is that because student loans are offered to all students without any kind of credit scoring or other criteria attached to them, that they were somehow race neutral. And all three of those assumptions have been shown to be incorrect. So as Marshall said, increasingly student debt is being used to finance education for lower income students in addition to middle and higher income students. Number two, as we showed in our paper together, we have had a huge increase in the amount of student debt, particularly since the Great Recession. We've had a modest increase in levels of education across the board, but we've seen virtually no change in earnings outcomes, right? So Marshall speaks to this better than I do, but the distribution of earnings in the labor market largely stayed the same despite that huge increase in student debt. I think that's a key factor that's often left out of the conversation about how the student loan program is functioning. And then the third assumption about race was one that really sort of flew under the radar for far longer than one could have even imagined until we got some good data in about, I guess now going on 4 years ago, that started to show the real racialization of student loan outcomes. So Black borrowers in particular fare far worse in the student loan program. They borrow at higher rates, they borrow more than their white counterparts, and they default at far higher rates than white borrowers. And we can tie a lot of that to the underlying racial wealth gap that puts them in a more precarious situation when it comes to paying for college. We can tie it to their concentration in for-profit colleges. It's tied to their need to attain graduate degrees to achieve the same earnings as their white counterparts. I think the missing piece that perhaps the next panel might talk about a little bit is that look, I think we all know that race matters in every step of the way. And so we've seen virtually at every point, from what kind of college you go to how you fare in the labor market, race has been a factor. It would not surprise me if race were also a factor in the type of servicing that students get on their loans and the way that they're affected by our debt collection system. That's a place where we actually don't have the data to show us what's going on. So I think I would guess that they're affected, that we have these effects at every step of the way. I think in terms of the pandemic, Marshall alluded to this a little bit. The way I see it is we are, in many ways, the federal policy response to this recession seemed to learn some lessons from the last one. It sort of seemed like, at least on the Democratic side, there was some awareness of lessons. I don't really see that in higher education, to be honest. I think, what we saw in 2007, 2008 was that we didn't provide enough or sustained enough relief to state and local governments. And as a result, the public investment in public education declined, and tuitions rose and debt loads rose. We seem to be headed into that situation all over again. And then on top of that debt load that exploded between the last recession and this one is still sitting there. So we have we'll have a future generation of borrowers who are taking on debt and coming out into this economy. But we also have those people who took debt along the way, whose student debt was at a crisis level in March and April, who are now headed into or in the midst of an extraordinarily difficult labor market. And I think there again, we want to be attuned to the way that race plays into this, right? We know that Black borrowers were already in the most precarious situation. We also know that they're facing the highest rates of unemployment right now in this economy. And so we can expect that, like the outcomes there are going to be even worse. And so we've, it was encouraging for me to see the Democrats in March and April, look towards more aggressive solutions to student debt as part of their coronavirus response. But in essence, we've kind of frozen that conversation by putting the loans into forbearance and pushed it down the line. So we're still in the midst of I don't know, Marshall, it's like, I don't know what you call a crisis. It was a crisis before. I don't know if there's a word that is larger than that for what's happening right now, but if there is, we should start using it.
Thank you so much, Julie. And to turn to Jaleel, I know, Jaleel, you've also worked on the question of racial inequality in the higher education system and also geography of higher education access. So what are the core concerns that you would highlight about the debt crisis?
Well, thank you again. My name is Jaleel Bishop. I'm at University of Pennsylvania. And I just really think it's important for us to understand how data and research plays a crucial role in us understanding that there is a crisis, that there is a Black student debt crisis, but it's a part or a piece of the larger, I think, understanding or perspective that we need on the issue. And what I mean by that is that often we spend a lot of time reporting racial inequality or racial disparities, and sometimes struggle or are uncomfortable with having a conversation of what does a race conscious or kind of anti-racist approach look like to solving those racial inequalities. And the example that I like to give people sometimes is that I grew up in a racially segregated neighborhood, and I was on the border of a very affluent, predominantly white suburb. And when that suburb needed to apply for federal funds, it would often make my predominantly Black neighborhood hyper visible because it allowed them to get funds. But in other conversations about equality and opportunity, my neighborhood was made hyper invisible. And I think that is something that can play out also in how we're talking about the student debt crisis. Is right now, a lot of organizations, a lot of researchers and advocates use student of color's data to make the issue hyper visible or to make their reports or their organizations hyper visible. But then when it comes time to have the conversation about race conscious policies or anti-racist policies, there's this silence or at least neglect to understand how important it is to make sure that we can explicitly say how Black people are going to be included and how we can protect or at least anticipate the ways that systems of racism are going to try to exclude Black people. If that's through the technicalities of paperwork, if that's through the technicalities of who's eligible for the programs, we need to really start to think about how we can have race conscious and anti-racist policies, and not just a universal or a class-based approach that we think will by default include Black people and communities of color. So that's something I always like to start out the framing with, because it's important for us to understand that data is one piece, but we can't just allow big data to kind of drive the conversation without including Black voices and communities of color. So in my research around student loan debt, I've been really focusing on how do we capture these voices. And I've been collecting stories of Black borrowers since about 2017 now. So by the end of this year, I will have interviewed somewhere between 150 to 200 Black borrowers who are right now living with student loan debt during this pandemic, but also, as other panelists have said, we're already experiencing student debt as a crisis. And what is being made clear in these stories, as I'm talking to borrowers all over the country, is that many are describing their student debt as a lifetime sentence, as something that they felt like they had no other option but to borrow in order to earn a college degree and be able to have some type of chance at earning a living wage. And that's what I'm hearing from borrowers who are making $40,000 a year, all the way up to Black borrowers who are making six-figure incomes. Another piece is that the debt is generational. When a Black student borrows, their parents also borrow, and there's this generational impact. Parents are telling me that when they borrow for their older child, that often they're not able to do that for a younger child. So you're seeing this generational impact that is affecting how debt is kind of being piled on to different families and across communities. The last piece is that debt interlocks with other debt. So as a part of needing student loans is that you don't have a strong economic base to begin with. And we know because of historic and ongoing policies that that is something true for Black communities and communities of color. So people are explaining to me the stories of how their student loan debt is leading to more credit card debt, payday loans, and lower credit scores, which we know will lead to a range of issues. So a piece for me is that we need more data to understand how this issue plays out, and we need more data to continue to understand the nuances, but we have to move to a point where we can talk about what does it mean to actually address this racial inequality. And I think for me, that means that we have to expand who's usually included in this conversation, which, you know, is scholars like myself, policy analysts, like many people on this webinar. And we have to think about how do we bring in some movement builders, people who are able to build a capacity, and I think the political will to actually bring debt cancellation to the forefront and bring debt cancellation in a way that really allows for an anti-racist perspective to be centered and championed. So I'll pause there and thank you.
Thank you so much, Jaleel, and all of our panelists in this first section. So now I'd like to open up for the initial Q&A section. For those who joined a little bit late, we're going to move into the policy section after this first Q&A and then have another Q&A portion for the second batch of panelists. So if you have questions for Laura, Marshall, Julie, and Jaleel, please post them either in the chat or in the Q&A box at the bottom of the Zoom screen. And I think I actually can start us off while folks are getting their thoughts together. One question I wanted to ask Jaleel, especially your research on institutional and policy power dynamics, how it contributes to racial inequalities is particularly salient in a lot of the research that's been mentioned. What are policy changes you think are a priority, not just to alleviate Black student debt, but to increase opportunity as well?
Yeah, well, I think, a big part of this, again, is starting with asking ourselves how our policies or our perspectives or our research conclusions doing something to think about what does it mean to be anti-racist. And I think that is really critical to start any of these conversations. So, in my work, I often try to show that the ways that racism or racial inequality shows up is not necessarily in these, in these explicit or obvious ways, but really in the technicalities of how policies are implemented. That it's through, the paperwork or through a barrier that's within particular institutions or organizations. And what we are seeing, not only inside higher ed institutions, but also in government policy, is that when we are on the front end thinking about how to make sure they're racially inclusive and put in protections to counter the ways that they may be racially exclusive, that they almost always lead to these same conversations where we have to say, here's the data on racial disparities, here are the ways that Black people are being left out. And there's always kind of this undertone that we're a little surprised by that. And I think we have enough history now and enough really amazing research to show us that we need to be more proactive on that end. So kind of key policies and thinking about that is, of course, debt cancellation to do with student debt, but also thinking about how do we challenge this stratification that we're seeing in higher ed right now, where poor students and students of color are being concentrated in institutions that are often underfunded. That leads to just, again, an array of issues with graduation rates and persistent rates. You're muted.
Hal, I think you're muted.
Thank you all so much. That happens every day for all of us. Lauren, Marshall, we have a question in the chat here that I'll read out. I wonder if you can speak a bit more on the relationship between broadband access and education access, particularly as COVID increases reliance on internet. I'll hand it to Marshall.
Sure. So one of the things that coming up with these geographic-based analysis, geographic-based measures of higher education access is that we can then compare it to geographic access to broadband. And I think that highlighted an important point here, which is that online learning and online degree programs have been kind of pointed to as a potential solution to higher education access issues and affordability issues in recent years. And I think the experience with COVID has highlighted that's a little bit over-optimistic relative to what these alternatives really offer as by way of real options for people. And what you can see from this geographic-based analysis is just that the places that lack access to higher education options also lack access to broadband. We don't have universal broadband by any stretch of the imagination. And what that means is that it's not a real alternative if you're thinking about people who lack access to traditional higher education. And I think that sort of whole online learning as an alternative to traditional systems as supposedly an egalitarian force that's been pretty current in the sort of public debate over the last decade, I think has really been shown to be false right now, but also, there's good reason to think it has been going back a long way.
Thank you, Marshall. And I have one other question, if Julie, we have time for that. In particular, you signaled a little bit, and this will help us transition to the next section. You signaled a little bit towards policy changes. I wanted to ask if you could identify some of the policy changes you think that are really a priority right now, not just to alleviate Black student debt, but once again to enable sort of remediation of the negative impacts that we're seeing.
So I think on the debt side of things, the actions we need to take right now are relatively straightforward. We need to cancel student debt. We can and should do that in the broadest way possible. We don't need to try to conserve dollars here or determine who is the neediest. Broader debt cancellation has the most positive effects for Black borrowers, but it also alleviates larger economic burdens that could be helpful to the country right now. And that, as we've published reports at Roosevelt and others, including the lawyers from the Harvard Project on Predatory Student Lending, have published some analyses to suggest that this is something that can be done through executive action. Obviously, it can be done through legislation as well, but the president, our current president, has said that he'd like to do some executive action on student loans. Most of his executive actions seem to be in the opposite direction in terms of building up student loan debt, but it's always available to him, definitely available to the next president as well. I think that there are some tougher questions around what to do around higher education right now. The way that I observe the conversation about higher education is that we were having a helpful debate about free college within the presidential primaries. And as soon as COVID hit, that came to a halt. And we're instead kind of like bailing out the college system as is, no strings attached, to the extent that we've done anything really. And then we're also we've bailed it out, no strings attached, but we've also not done enough of that to really mitigate the effects of COVID on the economy. So we're, if anything, moving backwards. So to me, this is actually, it feels like the wrong time to have a conversation about reforming our system, but it's actually the exact right time to do that. We should be doubling down on public options for higher education. But I take really seriously this question of a lot of the conversation around investing in public higher education and creating free college acts as though universality is what will solve our problems, and it will not. I think the report that EdTrust put out recently, I think it was actually an update on an older report, but about the concentration of Black students in in colleges that are less well-funded, and then their sort of absence in the state flagship colleges is a real and enduring problem in our higher education system. And it's hard to see how we move forward on any kind of funding for higher education without dealing with that problem, but especially moving to a free college system. So I think we should be having that debate right now and not avoiding it and just kind of throwing money at colleges.
Thanks so much, Julie. And I'm going to pass now to Laura to facilitate the next section on policy. So this is a great transition.
Yeah, I think especially given that we were just talking about the higher ed system and different policy solutions on the table or not on the table, as we're seeing right now. It's a good segue into this next part of of this panel into our different experts on policy, especially right now. So I'd like to start with Jen at the Century Foundation. The higher ed team has done a lot of research into racial disparities in college affordability and the student debt crisis. Can you walk us through some low-hanging fruit in terms of policy to alleviate the affordability crisis? And then what is and isn't included in the proposed legislation?
Sure, and thanks so much for hosting this event. As was discussed on the first panel, we both need policies that provide relief to struggling borrowers who are facing the worst economy, perhaps of their lifetime, and policies that ensure that new debt accumulation does not accelerate, particularly at the rate that we saw in the wake of the Great Recession. So that means broadly, we're talking about solutions that relieve immediate financial distress caused by the pandemic for students and borrowers, that address inequality that is being exacerbated by the pandemic, and in the context of student debt and higher ed finance, as has been mentioned, particularly important to pay attention to solutions that specifically address racial disparities in higher education funding and debt. And third, that pave the way for a robust and equitable recovery. So I'm actually going to focus my time more on reducing future debt, and I think some of my co-panelists are going to spend more time on some of the debt relief provisions that have been discussed. So as Julie talked a bit about, a lot of the conversation has been around ensuring that schools and particularly public institutions can provide education without increasing tuition, without cutting some of the financial aid programs that are increasingly important during the pandemic, when more students and more families lose their jobs, income, and savings. The Center on Budget projects that state budgets face shortfalls of over $500 billion through 2022. That's just state funding, that's not including local budgets. And we know that a lot of community colleges in particular rely on local funding streams as well. And we're already seeing some cuts happening, again, as Julie mentioned, to higher education budgets, or we're seeing things like states passing budgets and writing in cuts contingent on whether or not they receive new federal funding. And as has been discussed, we saw this play out in the Great Recession when states slashed their budgets. Many states never got back to the per student funding levels that they had before the recession. And we also know that during an economic downturn, more students tend to turn to colleges, particularly when opportunity costs are low, and particularly to community colleges. And I know a lot of the conversation right now has been about whether students will enroll this fall at the same numbers or fewer. But even during the Great Recession, we saw that effect was kind of a lagging effect toward the back end of the recession. And so over the next couple of years, we may see a similar effect where more people are turning to colleges, particularly community colleges. So what does this look like in terms of policy solutions on the federal level? What do we need? We need to see some of these investments at scale to states to support their public higher education institutions, to HBCUs, to MSIs. This has looked a little differently depending on the proposal. So we've seen some, particularly the HEROES Act in the House relies more on direct to state funding. Which provides a benefit because it creates a state partnership where you can ask states to do more to make sure that they're not cutting that funding. You could potentially have that conversation that Julie's talking about in terms of how they're actually sending dollars out to institutions. You have some proposals that rely kind of on both a direct to state funding and a direct to institution model. And we see that in the Senate Democratic proposal that came out a few weeks back. So they have both a significant pot of money that goes directly to states and then the bulk of the money that goes directly to colleges, to institutions. And that proposal in particular is at a is really at quite a larger scale than a lot of the other proposals. So they would actually send about $132 billion to higher education. And with all these proposals, the details matter. So it matters what you're expecting of states. Are you asking states to maintain funding and to come back to the table as their economies actually get better? Are you making sure that when you're saying you can't cut funding, that you're including state financial aid, for example, which wasn't included in the stimulus package that was passed in 2009? The HEROES Act in particular has a strong maintenance of effort. It actually does ask states to do that. Are you including an automatic stabilizer provision that says we're going to keep up this support as poor economic conditions persist? Are you making sure that the Department of Education doesn't try to inappropriately exclude certain students, like undocumented students, from receiving this money? And then when you send that money out the door, how are you actually creating a formula to make sure that the institutions that are serving low-income students and students of color are receiving the funding they should be receiving? And I think Ben's going to actually talk more specifics on what the formula looks like to make sure that that's crafted in a way that those schools are receiving those funding, particularly community colleges. And then I'll just put two more notes on the table. One is that all of this, has to be done within also a conversation of accountability to make sure that the predatory practices we saw increase during the Great Recession, that for-profit colleges are not increasing, that they're not pocketing, emergency stimulus dollars and then turning around and using it for predatory recruitment, et cetera. And the second flag I would say is higher ed should also be paying attention to the conversation around the broader relief and recovery. So for example, unemployment insurance, a lot of the reforms there actually really impact students. The CARES Act provided a new unemployment insurance program that was extremely helpful to students who are working and who often otherwise can't get state support. The Senate Republican proposal would actually roll that back and exclude them. I mean, it would roll back a lot of the benefits that exist right now, but it also specifically would exclude some students. So I think paying attention to the broader relief package is important as well. So I'm going to stop there and hand it over to Ben.
Yeah, Ben, I think, especially everything that Jen said about the a funding crisis that's happening and how these funds are being distributed you can really speak to, because of all the work that Center for American Progress has done about the drawbacks of the higher ed relief and debt relief in the CARES Act and the proposals on the table. So would love to, take it away.
Yeah. So just to very quickly echo something that Jen said at the top, I think it's really important to remember here that we really need to have three things. We need debt relief, we need money for colleges, and we need money for states. And that if you only do one of those things, you're probably going to sort of undercut all the benefits you'd get. So, if we help borrowers but don't do anything on the state side, the economy's still going to be in terrible shape. So hopefully we'll relieve some debt, but there's not going to be jobs to go back to. If we just bail out colleges but don't do anything on the state side, you're going to just see states essentially cut however much we give to colleges, and you'll completely negate whatever you do there. If you just give it to states, well, what we've seen is when you give states complete discretion on giving money to colleges, they don't always prioritize the needs of the places that serve the most of today's learners, the most students of color, the most low-income students, things like that. And you wouldn't then be doing anything for borrowers either. So it's really not it's an and, not an or among these things. On the funds itself, I mean, one of the things we've really seen here is that the CARES Act, I think, made two really major choices. One, you can understand why. The other, I don't think made any sense, that really had major implications for the fairness in awarding the dollars. So the first choice that it made was to allocate the funds based upon what we call full-time equivalent enrollment. And this essentially adjusts a part-time student to be equivalent to only a fraction of a full-time student. And what we saw of that is it essentially resulted in a substantial reduction in the potential funds that would go to community colleges in particular. So community colleges educate somewhere on the order of 35 to 40% of students. They got about 27% of the dollars, while public four-year colleges that educate somewhere like 32 to 34% of the students got like 44% of the dollars, and private nonprofits also were substantially overrepresented. And so one of the things we're really hoping to see going forward is a way that allocates those funds based upon essentially headcount, that treats all students as equal to one another. And if you do that, that has a much more of a leveling effect. It is much, much better for community colleges. It's much more generous for them, and would hopefully get funds to where they need to go. Because I think one of the earlier panelists alluded to this, but like part of what led to the massive spike in for-profit colleges post-Great Recession was enrollment really grew at community colleges, but funding didn't. And so community colleges started to really tap out in terms of their capacity, their ability to enroll people in various programs. And that created a market opportunity that for-profits exploited very, very effectively. And so I think if you don't fund community colleges, in addition to all the bad effects you'd have in terms of increasing debt levels for students who are at greater risk, you're going to also sort of help the for-profits along the way. The other major choice we saw in the CARES Act was it treated essentially all colleges equally within the formula, which meant that we sent direct institutional operating support payments to for-profit colleges, which I don't think is defensible in any sense of the manner. The whole pitch on a for-profit college is that it is serving, or it can show its worth by virtue of the private sector. And the fact that we spent about 4% of the formula dollars on CARES just for institutional support for for-profits, I think doesn't make any sense. The good news is it looks like in the future, the for-profits are going to be somewhat more relegated. HEROES takes them out entirely. The Murray bill puts them in a small set aside. The Mitch McConnell HEALS Act puts them in a 5% set aside that is available for all schools that are most affected. So it does look like they'll be somewhat more basically the rest of higher will be somewhat more protected from them. Although, again, the notion that we would give them operating support, I think, is highly, highly questionable, especially when you've got the PPP program and other ways to invest in private businesses and put them on akin with bars and things like that. On the debt side, just very quickly, I mean, I think, we unfortunately saw no progress on actual cancellation of dollars in the CARES Act, and it perhaps unsurprisingly was not included in the HEALS Act. We have seen calls for cancellation in both the bills from Murray and the House Democrats and the HEROES Act, which is really good. And I think one thing I want to highlight very quickly on those that I think is particularly good is I like the fact that they do their cancellation up front. There have been debates at various points in time to essentially cancel payments along the way and then do a sort of top off at the end. And I think actually up front is much more equitable, because what it means is those folks who have low balances and are struggling and in either default before this started or headed toward default kind of could get their whole balance wiped out right away, rather than waiting for the end of sort of when this all happens to get wiped out. The other thing I would say about that is I think that intentionally there's really no targeting done here. And I think that it's really important to understand that even if you think targeting is a good idea, it's not a good idea to do it now, because one issue you have with targeting is typically you want to do it based on things like income. And the truth of the matter is we don't know the income of most student loan borrowers, and we don't know the income of any student loan borrower who's not on income-driven repayment. And even for those who are on income-driven repayment, we know that their income as of whenever they last filed for it, which could be radically different. So you could have people who had a good income and lost their jobs. And so if we do means testing, they're going to look like they're in a different circumstance than where they are today. And so, I think that it'll be a tough fight, I think, on getting any sort of cancellation. Hopefully there'll be some progress there. I think it would be pretty ridiculous at this point to not get some sort of extended student loan payment pause, because I think the notion of making 40 million borrowers start paying again right now is just completely illogical. But I think that there should be an understanding that anything you might want to do around targeting in a normal environment really doesn't make sense now, and really isn't even feasible, even if you are generally sort of predisposed toward the targeting conversation. So with that, I will stop.
Yeah, that makes perfect sense. And especially speaking to how for-profits siphoned off students after the Great Recession, I think that, Mike at the Student Borrower Protection Center, you guys have done a lot of research working to curb the predatory student loan companies and for-profit schools. So, do you see any end in sight to these practices and proposed legislation? What issues arose with the CARES Act in particular?
I think that's a really great transition, and it's helpful to think about what the CARES Act does in the context of what the CARES Act doesn't do, and then maybe also the gaps in the additional proposals that have been floated, including the HEROES Act and Senator Alexander's proposal on the Senate. So, as a starting place, the the CARES Act, Ben's comments around targeting are a really good transition here. So the CARES Act was, with respect to student loan borrowers, broad-based. It did not make an attempt to target. It paused payments for all people with student loans that are owned by the federal government. That means that it left out about 9 million people that have private student loans or older federal loans that were made by banks and other private lenders, or loans made by schools through the Perkins Loan Program. But for everybody else, which is around 40 million people, student loan payments were paused and have been paused since March. It also suspended wage garnishment and other forced collections, which our colleague Persis is going to talk about as soon as I'm done. But the payment pause being universal really has some merits in this moment for a bunch of the reasons that Ben laid out. And also because the student loan system is on its best day, not dexterous. It's not capable of seeing problems among student loan borrowers and responding quickly. It's not even capable of seeing problems among borrowers and responding slowly. And the kind of the failures of income-driven repayment and the right that borrowers have to make payments based on their income really show why opting into payment relief, which is what Senator Alexander proposes, is a very strange policy choice in a moment where there is kind of broad financial distress across student loan borrowers. And we just saw yesterday, for the first time, some of the first household economic data that's tracked by the Federal Reserve Bank of New York shows that student loan borrower distress has dropped by about half over the course of the past quarter. And that is just the effect of the CARES Act's pause on student loan payments, I suspect. There's a kind of the inverse of what the CARES Act does, seems to have been adopted voluntarily by credit card issuers and mortgage servicers. So you can contact your consumer finance company kind of broadly and ask to pause your student loan or your mortgage payments or your credit card payments if you're struggling financially. And what we see in the economic data is that borrower distress, particularly in the credit card market, has increased as the recession has ramped up and the pandemic has really taken hold. In contrast, you have this universal payment pause under the CARES Act, and that's resulted in fewer student loan borrowers in distress. And you're seeing that in the economic data now. And that's a really good piece of evidence to support continuing the CARES Act payment pause. But it's also helpful to think about what comes after the recession starts to abate and the pandemic, we get control of it. And Julie's point about administrative student loan debt cancellation is a really good one. We've seen Congress, particularly congressional Democrats, embrace different proposals to cancel debt. There was the $10,000 worth of debt cancellation for everybody in the Senate Democrats proposal from back in March. The HEROES Act included a targeted proposal to cancel student debt for economically distressed borrowers. There are some challenges around operationalizing that targeting, in addition to some challenges with the general idea of targeting student debt, particularly if you take an equity lens to what you want to achieve through debt cancellation. But it's good to see Congress thinking about broad-based debt cancellation. And I think that it's helpful to think about the administrative tool too. So Alexander's proposal does none of these things. The House proposal takes a step forward towards giving people some kind of enduring debt relief. But really, we have an opportunity here for an administration of either party to use the tools that it has under current law to be able to cancel student debt for some people, for everybody. And when you talk about the strain in the student loan system, the inability of the student loan system to respond to the crisis quickly, canceling a modest amount of student debt, even $10,000, will pull about a third of all student loan borrowers out of the system. That means the system is better able to serve everyone else, and you will not see some of the same problems we see with income-driven repayment and other interventions if you just pull the most distressed borrowers out of the system completely.
Yeah, I think that that is also a good transition to Persis's work. And National Consumer Law Center has done a lot of advocacy work for students, even before the pandemic hit, of course. So what are some vital protections for the folks that SLBA are pushing for in the next Corona relief package? And also, I'd like to say that if you guys, some of the audience, have questions, feel free to start chatting them to me privately or in the public chat.
Thank you. Hi, everyone. My name is Persis Yu. The Student Loan Borrower Assistance Project at the National Consumer Law Center works on behalf of low-income student loan borrowers in particular. And I think just to start with by saying that, like so many other things in the pandemic, this crisis has exposed so many of the deep-rooted problems that we have with the student loan system, with the racial disparities that Jaleel and Julie mentioned earlier. And it has really exposed some of the really horrendous ways that we treat the most vulnerable student loan borrowers, in particular those who are in default. In normal times, the federal government hammers defaulted student loan borrowers with collection tools like tax refund offset, Social Security benefit offset, meaning they're seizing portions of the Social Security benefits, and the tax refunds are taking the entire thing, seizing borrowers' wages without a court order. And what this pandemic has finally exposed, which I think a lot of us maybe knew somewhere, was that during a crisis, people need their money. They need to hold on to their money, and that helps them weather the crisis a whole lot better. We did a report, released a report just last month on the effect of taking borrowers' earned income tax credits. And what we saw is that borrowers who lost their earned income tax credits experienced a lot of housing instability, that they experienced discussions about, or they told us about how they struggled to feed their children, how they were struggling even to get to work if they were still working because they couldn't fix their car. So having access to these funds is really critical, and it remains really critical, though I think it's probably worth mentioning that low-income folks have crises at times that are not during a national pandemic as well. But the CARES Act, like Mike mentioned, did see some of these collection efforts. So borrowers should not be having their wages taken if they have federal student loans. They should not have had their tax refunds taken, though that only started in March, which left a whole swath of people in February still without their tax refunds. And some of the research shows that people who need their tax refunds the most file earliest. So it incidentally kept the money from the people who really probably needed it the most. But those efforts have been bumpy, is I think a word that Mike had used. It's been bumpy efforts. We're now 4 months into the payment pause. We're talking about turning repayments back on, and yet still thousands of borrowers are experiencing wage garnishment because the system is that broken that it cannot turn off wage garnishment, despite the fact that Congress back in March directed the Secretary of Education to cease those collection efforts. The borrowers that we hear from are terrified about the fact that collection, we talk about the student loan system turning back on, but what that means is that collection is starting again on October 1st. Borrowers are going to start experiencing wage garnishment again. They're going to start, if they're receiving Social Security, disability, or retirement, they're going to start seeing those benefits seized from them. And I think it's worth mentioning, in addition to the problems that Mike has talked about in the HEALS Act, is that the HEALS Act provided nothing for defaulted student loan borrowers. There was no relief for this group of borrowers, and many folks don't have any way to get out. And so we've been looking at the system in kind of a two-way approach. We both need to triage the system and we need recovery. So triage, to us means we need to extend the payment pause, and we need to extend it for all student loan borrowers, the commercial FFEL and the and Perkins borrowers and private student loan borrowers. But we also need to look towards recovery. And I think, as my colleagues have spent a good amount of time talking about, we need things that will help borrowers recover, which is going to be things like debt cancellation to put people in better standing. But we also need to look more broadly at the way that the student loan system works. Right now, we have no statute of limitations, which means that they can follow borrowers, for their entire lives if they're in default. And so we need more long-term solutions to not just get us over this hump, but to make sure that borrowers, student loan borrowers, and the most vulnerable student loan borrowers, those in default, are able to recover along with the rest of the country.
Yeah. It looks like we have a follow-up question already for you, Persis. And it looks like we might go a couple minutes over, but of course, feel free to drop off if you have a hard stop. But for Persis, some policy proposers gaining bipartisan popularity on the Hill include expanding Pell Grants, expanding PSLF, which is public student loan forgiveness, streamlining IDR, continuing expanding the loan repayment fees. What should policymakers prioritize right now?
Well, I think, we need to look at, first of all, we need a payment pause right now. I don't know that there's any way to get around that. we cannot turn collection back on October 1st, and we need to make sure that that is available to everybody. But I think, you know, debt cancellation is a really high impact way to get relief to a lot of folks. And so we need to look at that, but we need to also recognize that there will still, you know, there will be some folks who are still struggling. And so we need to make sure that payment is easily available, and we need to make sure that servicers are doing their jobs, and make sure that there is an easier ramp onto income-driven repayment. We have called for letting borrowers who fall into delinquency be automatically enrolled in income-driven repayment, so that people don't fall into default just because they have failed to do the paperwork. So those are some of the ideas that we have, and we have posted our priorities on our student loan borrower assistance blog as well.
That's great. Jalil, I don't know if you wanted to talk a little bit about the Black student debt study. You guys have done a lot of really great research already.
Sure, thank you. Just a quick plug with Education Trust, we're right now running a study focused on Black student loan borrowers, where we have a national survey, but also interviews where we're trying to just capture what are the lived experiences of Black borrowers. So we're asking everyone who is a Black student loan borrower to participate in the study, but also if you are not, please share with your networks, your organizational networks. We're really looking to increase representation among Black borrowers with debt and no degree or credential. So again, just share. We'll repost the link in the chat, and it will just be great to get as much participation as possible. Thank you.
Great, and I'll just ask one final question. I think probably Mike, Jen, or Ben could answer this. We have a question from Alan Yeck in the chat. The cost of higher education passed down to students include mismanagement of the funds, whether it's state or federal dollars. If there's no true oversight, how the money is spent, or in some cases maybe wasted, how can we continue to fund these in this way?
So, I mean, I think, you know, part of that is there are certain institutions which should not be funding either as much or at all, right? So, you know, some of the waste is happening at for-profit colleges. Some of the waste, honestly, we're seeing, I wouldn't call it waste, but some of the mismanagement we're seeing is honestly, I think, a function of insufficient investment in the public institutions. Like, I think that the University of Arizona would not be buying the completely awful institution that is Ashford if it had been sufficiently invested in over time. I think that you're seeing even some of the bad choices colleges are making in terms of reopening, I think is partially at least a function of insufficient long-term investment that's forcing them into making choices that are not optimal for students in the long run, just because they need to sort of secure their revenue, secure their bottom line. But I think if you were to do that, which is part of the theory behind what Jen was talking about on like increasing funding to states with conditions in place to say states have to maintain effort, you should also then pair that with greater accountability to ensure that, you know, we're not then loading students up with too much debt, that people have a realistic shot of completing, that students are getting the supports they need and things like that. But I think the path into that is by actually changing the relationship between the federal government and higher education by actually incorporating the states in a meaningful way, which we just don't do today.
Well, we are now definitely over time. I want to thank all of our panelists, both in the first and second section, for coming today. All of our audience members for tuning in. We've had a really great discussion, and you know, we'll have some follow-up chats in our Twitter feed this afternoon. So stay tuned for another panel, hopefully soon. Thanks, everyone.
Thank you, Laura.